Stop. Stop what you are doing right now. I need you to take your eyes off the silver chart for 30 seconds. I know. $73. $73 and change on a Wednesday afternoon, and your portfolio just did something it has never done before, and you are sitting there refreshing Kitco like a kid on Christmas morning, and I get it, I really do. But I need you to stop celebrating for 1 minute, because what I am about to show you is the single most terrifying piece of financial data I have seen in my entire career, and I have been doing this a long time. I have been staring at these screens since 2008. I watched Lehman collapse in real time. I watched Bear Stearns get swallowed whole on a Sunday night. And what happened this morning at approximately 11:45 Eastern Standard Time on this Wednesday in March of 2026 makes all of those events look like a dress rehearsal. This is the main event. This is the crime scene. And nobody, and I mean nobody on financial television is telling you what actually happened, because if they told you the truth, if they looked into that camera on CNBC or Bloomberg and said the words I am about to say, the entire charade collapses. The illusion disintegrates. The confidence game that holds together every single dollar in your bank account, every single treasury bond in your retirement fund, every single mortgage payment you make on the 15th of the month, all of it gone, vapor, dust. Because here's what happened today. While you were watching silver scream past $73 and gold punch through $4,580 like it was nothing, like it was tissue paper, while you were watching that beautiful green candle on the 4-hour chart, the United States Treasury, the beating heart of the global financial system, the institution that every single central bank on planet Earth is supposed to trust with their reserves, that institution walked into the bond market this morning with $69 billion worth of 2-year notes and said, here, buy these, fund our government, keep the lights on in Washington, and the world, the entire global bond market, every single institutional desk from Tokyo to London to Frankfurt to Shanghai looked at those $69 billion of American debt and said no. They said absolutely not. They said we are not buying your garbage. They rejected it. The auction failed. Not underperformed. Not came in slightly weak. Failed. And that right there is the real reason silver just hit $73. That is the real reason gold is at $45.80. It is not a short squeeze. It is not retail mania. It is not Reddit. It is not TikTok kids buying silver eagles. It is a full-scale institutional panic out of the United States bond market and into the only assets on planet Earth that cannot be printed, cannot be debased, cannot be defaulted on, and cannot be sanctioned. Physical gold and physical silver. Hard money. Real money. The money that has been money for 5,000 years, while every single fiat currency ever created has gone to zero. Every single one. Now the suits want me to tell you this is not financial advice. Of course it is not. It is a survival guide for a burning theater. The exits are getting smaller. The ushers are telling you to stay calm and remain seated. I am the guy standing on the chair in the back row screaming at you to get out now. Do your own research if you still trust the people who stole your purchasing power. I am just a guy with a spreadsheet, a chart, and an unhealthy obsession with the repo market. But the data does not lie. The bond market does not lie. Politicians lie. Central bankers lie. Treasury secretaries lie. But the bond market is the one place in this entire rigged casino where the truth leaks out, and today the truth is screaming so loud that even the deaf can hear it. The United States of America is functionally insolvent, the world knows it, and the stampede into physical precious metals is not a trade. It is an evacuation. Now, before I go any deeper into this crime scene, I need you to smash the like button right now. Not later, not after the video. Right now. Because here is the reality of 2026. The algorithms do not want you to see this. The shadow ban is real. I have seen my impressions get cut by 60% in the last 90 days. Every single time I talk about Treasury failures, every single time I mention the words bond market collapse, the algorithm buries this channel. So if you want to fight back, if you want to break through the digital suppression, you hit that thumbs up and you hit it hard, because that is how we get this information to the people who need it. That is how we break the blockade. Do it right now. I will wait. Good. Let us get into the data. All right, so let me walk you through exactly what happened this morning, because this is where it gets really ugly. The United States Treasury, through the Bureau of the Fiscal Service, conducted a scheduled auction of 2-year Treasury notes. The total offering was $69 billion. Now, let me put that number in context for you because 69 billion sounds like a lot of money to a normal human being, but in the world of sovereign debt, it is actually a relatively standard midweek auction. The Treasury has been auctioning off massive blocks of debt every single week for years now because the federal government is running a deficit that makes your eyes water. We are talking about a fiscal deficit in 2026 that is tracking at approximately $2.1 trillion annualized. 2.1 trillion. Let me do that math for you in real time. $2.1 trillion divided by 365 days means the United States government needs to borrow approximately $5.75 billion every single day just to keep functioning. Every day. Saturdays, Sundays, holidays, Christmas. $5.75 billion of new debt every 24 hours. That is $239 million every single hour. That is $4 million every single minute. While you have been watching this video, the United States government has borrowed roughly $16 million of new debt, and that does not even include the rollover. That does not even include the existing debt that is maturing and needs to be refinanced. When you factor in the rollover schedule for 2026, the Treasury needs to issue somewhere in the neighborhood of $9 to $10 trillion of total debt this year alone. 9 to 10 trillion. And they need buyers. They need someone to show up at these auctions and say, yes, I will lend you my money for 2 years at whatever yield you are offering, and I trust that you will pay me back, and I trust that inflation will not eat my returns alive. That is what a Treasury auction is. It is the United States government going hat in hand to the global capital markets and begging for money. And today, for the first time in a way that I have not seen since the absolute chaos of 2020, the market said no. Now, how do we know the auction failed? Let me break down the specific metrics because this is important. This is not opinion. This is not speculation. This is raw auction data that the Treasury publishes for anyone to see if they bother to look, which apparently nobody at Bloomberg bothers to do because they are too busy telling you about the latest AI stock that is going to change the world. The key metric in a Treasury auction is something called the bid-to-cover ratio. The bid-to-cover ratio tells you how many dollars of demand showed up for every dollar of debt being offered. In a healthy auction, you want to see a bid to cover of at least 2.5 to 1. That means for every dollar the Treasury is trying to sell, $2.50 of buying interest shows up. That is a healthy, functioning debt market. That means people want your bonds. They trust your credit. They believe in your currency. Today's 2-year auction came in with a bid to cover of 2.08. 2.08. That is catastrophically low. That is the weakest bid-to-cover ratio on a 2-year note auction since October of 2023, which, for those of you who remember, was the exact moment that triggered the regional banking crisis that wiped out Silicon Valley Bank, Signature Bank, and First Republic. Let me say that again. The last time we saw demand this week for 2-year Treasury notes, 3 major American banks collapsed within 60 days. And here we are again, same signal, same data, same warning. But it gets worse. The second metric you need to watch is the tail. The tail on a Treasury auction is the difference between the yield that was expected going into the auction, what is called the when issued yield, and the yield that the auction actually stopped at. When the auction stops at a higher yield than expected, that means the Treasury had to offer more money, more interest, to convince investors to buy. It is the equivalent of a used car salesman having to keep dropping the price because nobody wants the vehicle. Today's 2-year auction tailed by 4.2 basis points. 4.2. To put that in perspective, the average tail on a 2-year auction over the last 12 months has been approximately 0.8 basis points. We came in at 4.2. That is more than 5 times the average. That is a 5 sigma event. In statistics, a 5 sigma event is supposed to happen once every several thousand occurrences. It happened today, on a Wednesday, in the middle of March, and nobody on television is talking about it. Now let me give you the historical parallels because this is where the pattern becomes undeniable. When have we seen Treasury auctions fail like this before? 3 times. 3 critical moments in modern financial history. The first was in August of 2011. Remember 2011? Standard & Poor's downgraded the United States credit rating from AAA to AA+ for the first time in history. The political circus around the debt ceiling had gotten so absurd that a major ratings agency said, you know what, America is not a risk-free borrower anymore. And in the weeks following that downgrade, Treasury auctions started tailing badly. The bid-to-cover ratios dropped. Foreign central banks started pulling back. Gold rallied from $1,500 to $1,900 in about 60 days. That was 2011. The second time was September of 2019. This one most people do not even remember, but I remember it because it nearly broke the entire financial system overnight. The repo market seized. Interest rates in the overnight lending market, the repo market, the plumbing that keeps every single bank in America functioning, those rates spiked from 2% to 10% in a single session. The Federal Reserve had to inject $75 billion of emergency liquidity in one night. One night. $75 billion. And why did the repo market seize? Because there was too much Treasury supply and not enough demand. The market was choking on U.S. debt. Nobody wanted it. Sound familiar? The third time was March of 2020, the COVID crash. The Treasury market, the supposed safest and most liquid market on Earth, froze solid. Bid-ask spreads on 10-year notes blew out to levels that traders said they had never seen in their careers. The Federal Reserve had to step in and buy $1.5 trillion of treasuries in a matter of weeks just to keep the market from disintegrating. $1.5 trillion. And that emergency buying is what created the inflation monster that we are still fighting 6 years later. Every single one of those three moments, 2011, 2019, 2020, was followed by a massive surge in precious metals prices. Every single time the bond market cracked, gold and silver went vertical. And today we just got crack number 4. Except this time is different, and I hate that phrase. Every analyst who says this time is different deserves to be mocked, but in this case the data supports it. This time the Federal Reserve cannot ride to the rescue. They cannot do what they did in 2020 because inflation is running at 4.8% on the CPI, and the real rate, the actual rate that anyone who buys groceries or pays rent knows is real, is closer to 8 or 9%. If the Fed steps in and starts buying treasuries again, if they restart quantitative easing, they pour gasoline on the inflation fire and the dollar collapses. If they do not step in, the bond market continues to deteriorate, yields spike, and the banking system comes under terminal pressure. They are trapped. Completely, mathematically, inescapably trapped. And the metals know it. Silver at $73 knows it. Gold at $45.80 knows it. The smart money, the institutional capital, the sovereign wealth funds, they all know it. The only people who do not know it are the ones still watching CNBC and believing that everything is fine. I dig through these complex bond yields and failed treasury auctions so you can see the fiat collapse happening in real time before the mainstream media admits it. If this macroeconomic reality check gives you the ultimate edge today, consider hitting that super thanks button below to support the channel. Every single super thanks allows me to keep the lights on, keep the data terminals running, and keep doing this research at a level that the mainstream will never match because they are bought and paid for by the same institutions that are dumping these bonds. Your support is the only reason this channel exists. The only reason. Now let me explain the mechanism. Let me explain why the auction failed today specifically, because it is not random. Nothing in this market is random. Everything is connected. Every single data point is a thread in a web, and when you pull one thread, the whole structure shakes. The reason institutional investors rejected $69 billion of 2-year U.S. Treasury notes today is one word: oil. O-I-L. 3 letters that are about to reshape the entire global financial order. Here is what is happening. The war in the Middle East, which has been escalating steadily since late 2023 and has now expanded into a multi-front regional conflict involving direct military engagement between major powers, that war has put the Strait of Hormuz at risk. The Strait of Hormuz. 20% of the world's oil supply passes through that choke point every single day. 20%. Approximately 21 million barrels per day. If that strait gets disrupted, even partially, even for a few weeks, oil prices do not go to $90. They do not go to $100. They go to $150, $170, possibly $200 a barrel. And what does $200 oil mean for inflation? Let me do the math. Energy costs represent approximately 7.5% of the consumer price index directly, but they feed into everything: transportation, manufacturing, agriculture, packaging, shipping. Every single thing you buy at a store got there on a truck that runs on diesel. So when oil doubles, the knock-on inflationary effect is not 7.5%. Conservative estimates put the multiplier at 3 to 4 times the direct weight. So if oil goes from current levels of around $88 to $170, that is roughly a 93% increase in the energy input, which filters through the economy as a 22 to 30% boost to the broad inflation basket over the following 6 to 12 months, 22 to 30%. On top of the 4.8% we already have, you are looking at CPI prints in the high single digits, possibly double digits, 10% CPI, 12% CPI, numbers we have not seen since 1980. Numbers that would make Paul Volcker spin in his grave. Now ask yourself this question. If you are a bond fund manager at BlackRock or PIMCO or Vanguard, and you are looking at a 2-year Treasury note that is yielding, let us say, 4.9%, and, you can see the geopolitical map, you can see the oil tankers rerouting around the Cape of Good Hope, you can see the naval deployments in the Persian Gulf, you know that inflation is about to rip higher, possibly much higher. Are you going to lock your money into a bond that pays 4.9% for 2 years while inflation runs at 8, 9, 10%? Of course not. That is a guaranteed loss of purchasing power. That is financial suicide. You are paying the government for the privilege of losing money. The real yield, the yield minus inflation, goes deeply negative. -3%, -4%, -5%. You are literally better off holding cash under your mattress. You are better off buying literally anything that is not a fixed income instrument denominated in a currency that is being debased at an accelerating rate. And what is the ultimate anti-debasement asset? Gold and silver. Physical gold and physical silver. Not paper gold, not the GLD ETF, not a futures contract. Physical metal that you can hold in your hand that has no counterparty risk, that cannot be defaulted on, that cannot be printed, that cannot be sanctioned, that cannot be frozen by executive order, that cannot be devalued by a central bank press conference. The real thing. That is what happened today. The bond market looked at the geopolitical risk, ran the inflation math, and made a rational decision to reject U.S. debt. And the billions of dollars that would have gone into that $69 billion auction did not just evaporate. That money went somewhere. It went into the metals. It went into gold. It went into silver. It went into copper. It went into commodities. It went into anything tangible, anything real. That is why silver ripped from $68 to $73 in less than 4 hours today. That is not retail. That is not you and me. That is institutional capital, sovereign capital, central bank capital, fleeing the burning building of the U.S. Treasury market and piling into the lifeboats, and the lifeboats are made of gold and silver. Let me know in the comments below, are you still trusting U.S. fiat dollars and government bonds, or are you aggressively moving into physical gold and silver like the institutional whales today? I want to hear from you. Tell me what your dealer is charging for Silver Eagles right now. Tell me the premium. Tell me if they even have inventory. Because I am hearing from contacts at multiple dealers, APEMX, JM Bullion, SD Bullion, Monument Metals, I am hearing that inventory is getting thin, really thin. The premium on American Silver Eagles is running $8, $9, $10 over spot right now. That is a premium of 12 to 14% on a government-minted sovereign coin. That premium tells you everything you need to know about the disconnect between the paper price and the physical reality. The paper price says 73. The physical price, if you can even find it, is $83, $84, $85. That is what we are approaching. Physical silver is becoming unobtainium at these levels because the demand is overwhelming the supply chain. Now let me talk about what this failed auction means for the banking sector, because this is where it gets truly terrifying. When a Treasury auction fails, when the bid to cover comes in weak and the tail blows out, what has to happen mechanically is that Treasury yields spike. The yield has to go up to attract the next round of buyers. The government has to offer more interest to convince people to lend them money. That is basic supply and demand. More supply of bonds, less demand, the price drops, and when bond prices drop, yields rise. It is an inverse relationship. Bond prices down, yields up. So what we are going to see in the coming days and weeks is 2-year yields pushing higher, 5-year yields pushing higher, 10-year yields pushing higher. The entire yield curve is going to reprice to reflect the reality that the United States is a deteriorating credit risk. And when yields spike, what happens to the banks? Remember 2023? Remember Silicon Valley Bank? Let me walk you through this because it is the exact same mechanic and it is about to happen again, except on a much larger scale. Banks hold Treasury bonds as their core capital reserves. It is considered the safest asset, the risk-free rate. Except it is not risk-free. It never was. When yields spike, the market value of the bonds the banks are already holding collapses. Because who wants to buy a bond paying 3% when new bonds are paying 5.5%? Nobody. So the existing bond portfolio gets marked down. The banks develop unrealized losses. In 2023, the unrealized losses in the U.S. banking system peaked at approximately $680 billion. $680 billion. That is what killed SVB. That is what killed Signature. That is what killed First Republic. They were sitting on massive unrealized losses. Depositors got spooked, a bank run started, and the FDIC had to step in. Well, guess what? As of the most recent Federal Reserve Financial Stability Report, unrealized losses in the banking system have climbed back to over $750 billion. $750 billion. That is higher than the peak of the 2023 crisis. And we just had a failed Treasury auction that is going to push yields even higher, which means those unrealized losses are about to get worse, much worse. You are looking at a situation where regional banks, and not just regionals, some of the mid-tier national banks, are sitting on a powder keg of bond losses that could be triggered by a depositor panic at any moment. All it takes is one headline, one bank reporting a capital shortfall, one nervous CFO going on an earnings call and saying something slightly wrong, and the dominoes start falling again. Except this time the FDIC's deposit insurance fund is already depleted from the 2023 rescues and the ongoing quiet failures of 2025. The fund is running a deficit. They do not have the money to bail out a major wave of bank failures, so what do? They go to the Fed, and the Fed either prints the money, which destroys the dollar and sends gold to 5,000 and silver to 100, or they do not print the money and the banks fail and the credit system freezes, and we are looking at a 2008-style liquidity cascade, except worse because the debt levels are 3 times higher than they were in 2008, 3 times. The total U.S. national debt in 2008 was approximately $10 trillion. Today, it is over $36.5 trillion, 3.65x. And the GDP has not tripled. The tax base has not tripled. The productive capacity of the economy has not tripled. Only the debt has tripled, which means the debt to GDP ratio has gone from approximately 64% in 2008 to over 127% today. We have crossed the Rubicon. We are in the territory that economists like Carmen Reinhart and Kenneth Rogoff identified as the point of no return. Once your debt to GDP exceeds 90 to 100%, historical evidence from 8 centuries of sovereign defaults shows that the probability of a currency crisis or a debt restructuring approaches near certainty. It is not if, it is when. And the bond market just told you it is now. Let me talk about the repo market for a second, because this is the plumbing. This is the infrastructure that nobody sees and nobody talks about, but that keeps every single financial institution in America alive on a daily basis. The repo market, the repurchase agreement market, is where banks and financial institutions borrow money overnight using Treasury bonds as collateral. It is the grease in the engine. Without the repo market, the financial system stops, dead, overnight. No ATMs, no wire transfers, no credit card processing, nothing. It all depends on the repo market functioning smoothly. Now, here is what happens when Treasury auctions fail and yields spike. The collateral that these institutions are using in the repo market, their Treasury bonds, loses value. When the collateral loses value, the lenders in the repo market demand more collateral. That is called a margin call. The institutions either have to post more bonds, which they may not have, or they have to sell assets to raise cash, which creates selling pressure across every asset class simultaneously. That is a liquidity cascade. That is the domino effect. That is how a failed Treasury auction on a Wednesday morning in March turns into a full-blown financial crisis by Friday afternoon. I have seen it happen. I watched it happen in September 2019 when the repo rate spiked to 10% and the Fed had to inject emergency liquidity. I watched it happen in March 2020 when the entire Treasury market froze and the Fed had to buy $1.5 trillion in bonds. The repo market is the canary in the coal mine, and right now that canary is gasping for air. Overnight repo rates have been ticking higher for the last 3 weeks. General collateral rates that normally sit right around the Fed funds rate have been printing 5, 10, sometimes 15 basis points above the target. That is stress. That is not normal. That is the system telling you that collateral is getting scarce, that trust is eroding, that the counterparty risk that everyone pretends does not exist in the Treasury market is starting to rear its ugly head. Rehypothecation. Let me explain that word because it is critical to understanding how fragile this system really is. Rehypothecation means that the same Treasury bond is being used as collateral in multiple transactions simultaneously. Bank A pledges a bond to Bank B. Bank B takes that same bond and pledges it to Bank C. Bank C pledges it to Bank D. One bond, 4 different institutions, all claiming it as collateral. Now what happens when the value of that bond drops because yields spiked, because the auction failed? All 4 institutions are suddenly under-collateralized at the same time. All 4 need to either post more collateral or sell assets. Multiply that by the trillions of dollars in the repo market, and you can see how quickly a crack becomes a chasm. The estimated rehypothecation ratio in the current repo market is somewhere between 2.5 and 3.8, according to research from the Office of Financial Research. That means for every physical Treasury bond out there, it is being pledged as collateral 2.5 to nearly 4 times over. The system is leveraged on leverage on leverage. It is a house of cards built on a foundation of cards on a table made of cards, and the wind just picked up. Now here is where the algo traders come in, the gamma flip. Let me explain this because the machines are running this market and you need to understand what they are doing. Gamma, in options terminology, is the rate of change of delta, which is the sensitivity of an options price to the underlying asset. When you have a gamma flip, it means the options market maker positioning shifts from short gamma to long gamma, and that creates a self-reinforcing feedback loop. In a short gamma environment, which is where we have been for most of 2026 in the metals market, market makers are forced to sell into rallies and buy into declines, which suppresses volatility and keeps prices range-bound. But when you get a massive fundamental catalyst, like, say, a failed $69 billion Treasury auction, the sheer force of the buying overwhelms the short gamma positioning and flips the market makers to long gamma. And in a long gamma environment, the market makers are buying into rallies and selling into declines. They are chasing. The algorithm flips from suppression mode to acceleration mode. That is what happened today in silver. The gamma flip occurred somewhere around 71.50. You could see it on the tape. The buying went from organic, institutional block trades to algo-driven, momentum-chasing, high-frequency madness. The algos smelled blood. They saw the bond auction data, they calculated the yield implications, they modeled the inflation trajectory from the oil risk, and they went all in on metals. Silver went from 71.50 to 73 in less than 45 minutes. That is a V-shock. A violent, algorithmic, momentum-driven spike that happens when the machines all reach the same conclusion at the same time and there is nobody on the other side of the trade. The shorts got annihilated. Open interest data from the COMEX is going to be staggering when it comes out tomorrow morning. I am expecting to see a massive short covering event, potentially 50 to 70,000 contracts worth of short positions that had to be liquidated today. At 5,000 ounces per contract, that is 250 million to 350 million ounces of paper silver that had to be covered, on a day when the physical market is already tighter than a drum. The registered inventory at the COMEX, the silver that is actually available for delivery, has been declining for 3 straight years. We are down to approximately 72 million ounces of registered silver. 72 million ounces. That is roughly $3.6 billion worth of silver at current prices. 3.6 billion. That is less than the market capitalization of a mid-cap tech stock. That is nothing. That is a rounding error in the context of a $36.5 trillion national debt, and it is supposed to backstop the entire global silver futures market. The ratio of paper claims to physical registered metal is now running at a level that I am going to calculate for you in real time. Total open interest on COMEX silver futures, approximately 140,000 contracts times 5,000 ounces per contract. That is 700 million ounces of paper claims against 72 million ounces of registered metal. 700 divided by 72, that is a ratio of 9.7 to 1. For every 1 ounce of real silver sitting in those vaults, there are almost 10 ounces of paper promises, 10 to 1. If even 10% of those paper holders stand for delivery simultaneously, the COMEX either declares force majeure, which means they admit they cannot deliver the metal and the whole system is exposed as a fraud, or the price has to gap up to whatever level it takes to convince physical holders to sell. And at $73, they are not selling. At $80, they are not selling. At $90, maybe some starts to come out. At $100, maybe. But the squeeze is real. The math is undeniable. The COMEX is a leveraged paper casino sitting on top of a tiny pile of physical metal, and the jig is almost up. Now let me bring in the geopolitical angle, because this is not just an American story. This is a global restructuring. While the United States is drowning in its own debt and watching its treasury auctions fail, the BRICS nations, Brazil, Russia, India, China, South Africa, plus Saudi Arabia, UAE, Egypt, Ethiopia, Iran, these nations have been systematically accumulating physical gold at an unprecedented pace. China alone has been buying somewhere between 50 and 100 tons of gold per month through channels that do not show up in official reporting. The Shanghai Gold Exchange has been recording gold withdrawals that dwarf anything we have ever seen. The People's Bank of China officially reports gold reserves of approximately 2,400 tons, But independent analysts who track import data through Hong Kong and Switzerland estimate the real number is closer to 5,000 to 6,000 tons. They have been accumulating in the shadows waiting for this exact moment, the moment when the world loses faith in the U.S. Treasury market. Because that is what is at stake here. This is about the end of the dollar hegemony. Since 1971, since Nixon closed the gold window, the United States has had the exorbitant privilege of borrowing in its own currency at artificially low rates because every nation needed dollars to buy oil and settle international trade. That privilege allowed America to run infinite deficits, fight infinite wars, and fund an infinite welfare state without consequence. But the consequence was always coming. It was lurking in the debt-to-GDP ratio, buried in the unfunded liabilities of Social Security and Medicare, totaling somewhere between $150 and $200 trillion. The consequence was deferred, not eliminated, and now it is here. The BRICS nations are building an alternative. SWIFT is being bypassed. Russia and China are settling trade in rubles and yuan. The M-Bridge project, the digital cross-border payment system being developed with the central banks of China, Thailand, UAE, and Saudi Arabia, is designed to cut the dollar out of international trade entirely. Saudi Arabia, the linchpin of the petrodollar, is now selling oil to China in yuan. The petrodollar is dead. It just has not stopped twitching yet. And what is replacing it? Gold, physical gold, the one asset that every central bank on earth trusts, the one asset that has no counterparty risk. The one asset that is not someone else's liability. Under Basel III and the Basel IV framework that is being phased in, gold has been reclassified as a Tier 1 asset for bank reserves. That means central banks can count physical gold at 100% of its market value as core capital. It is the same as cash, the same as Treasury bonds. Except unlike Treasury bonds, gold does not default, does not lose value when yields spike, and does not depend on the creditworthiness of a government that is $36.5 trillion in debt. The central banks of the world are telling you something with their actions. They are buying gold at a pace not seen since the 1960s. Global central bank gold purchases in 2025 exceeded 1,400 tons for the third consecutive year. They know what is coming. They are preparing for the post-dollar world. And they are not telling you about it on CNBC because if the American public understood what was happening, if they realized that the same institutions that tell them to buy Treasury bonds are secretly accumulating gold as fast as they possibly can, the panic would be immediate and total. I will be tracking these failing Treasury auctions and the massive institutional flight to physical silver all week long. Make sure you are subscribed to the channel with the bell notification turned on so you get my emergency alert the moment the bond market completely snaps. And make sure you are following the secondary channel down in the featured section below. We are running dual coverage now. The archive main channel for the macro analysis, the secondary channel for the real-time premium alerts and deep dive technical breakdowns. We are hitting them from both sides, every angle, every data point. Now let me give you the forecast. With the 2-year yield forced to reprice higher, with inflation expectations being revised upward because of the Middle East oil risk, with the Fed completely trapped, with the COMEX paper leverage at 9.7 to 1, with central banks buying gold at record pace, with the dollar index showing signs of breaking down from the 103 level, the technical and fundamental setup for silver is the most bullish I have seen in my entire career. The next major resistance above 73 is the $78 to $80 zone. That is where we see significant options clustering. That is the next gamma wall. Once silver punches through 80, there is nothing above it. Silver has never traded above 50 in the modern era until this cycle. We are in uncharted territory. The $100 target that I have been talking about for months, the target that every mainstream analyst mocked, that number is now a mathematical probability rather than a fantasy. If Treasury auction results continue to deteriorate, if oil breaks above 100 on a Middle East escalation, $100 silver is not a question of if, it is a question of when. And it might happen faster than anyone expects because the gamma flip has occurred, the algos are in acceleration mode, the shorts are covering, the physical market is tight, and there is no central bank cavalry coming to save the bond market this time. The world just sent a message to Washington. We will not finance your inflation anymore. We will not absorb your debt anymore. The fiat debt matrix is cracking in real time, right in front of your eyes, and the physical metals are the only escape hatch. Silver at $73 is not the top, it is the beginning. It is the market telling you that the 40-year experiment in pure fiat currency backed by nothing but confidence is ending, and a new monetary order based on hard, physical, tangible assets is being born. You can either be ahead of this or you can be a victim of it. There is no middle ground. If you want to see exactly how my portfolio is positioned to profit from this sovereign debt collapse, if you want to see my exact allocations between physical metal, mining equities, and strategic options plays on the Treasury complex, click the join button and become an insider member right now. The insider tier gets you my weekly portfolio review, my real-time trade alerts, and my emergency macro briefings when events like today's Treasury failure happen. This is not a game. This is not entertainment. This is survival. Physical gold, physical silver, hard assets, real money. Get it while you still can. Get it before the premiums go higher. Get it before the dealers run out. Get it before the next auction fails even harder. The United States of America cannot pay its debts. The dollar is dying, and gold and silver are the only money left. This is John CC, the Currency Archive. Wednesday, midday. The crime scene is still active. The evidence is still warm. Stay vigilant, stay stacked, and I will see you on the next one.